Hello, folks. Welcome to another episode of Restream. Today, I'm really excited because I have a special guest coming on to join us today. Josh Young is a mortgage agent extraordinaire. He's going to be joining us. We're going to have a bit of a discussion about mortgages. We're going to focus on some of the mortgage needs of first-time home buyers because this week, because I think it's the first-time home buyers that are really having a tough go of it in the current market. So Josh is excited and raring to go. I'm glad you joined us. Stay tuned. This is going to be a good one. All right, Josh, welcome to Restream. Thank you for joining me today. Oh, hold on, Josh. I don't have any sound.
Oh, my apologies.
There we go. There we go. All right, excellent. Just
Yeah.
one minor little glitch. No problems there. Thanks
Not
for
a
joining me
problem.
again, Josh.
Hi, I'm doing good. I really appreciate the invitation, and I'm happy to be here. And hopefully, viewers can get a bit of information and, yeah, just some quality information from the segment today.
Excellent, excellent. So, Josh, we talked about this earlier. We're going to try and focus on some of the needs of the first-time home buyers today. So I thought what we do first is just talk about some of the basics. So maybe give us a lowdown and, what should first-time home buyers expect in terms of the process when they're investigating mortgages?
Yeah. That's obviously with the market and C19 and everything that's going on. It's definitely changed a lot. My experience at the bank just before the seller's market was, typically, you know, buyers could go into the market and, they could look for a home and then call the banks or call your mortgage agent. Obviously, the traditional way of doing things and the correct way of doing things is to contact a lender. So whether it's your bank or a mortgage agent, especially in today's market, whereby it's first come, first serve kind of scenario, whereby there isn't a time to go back and forth with the seller. Is here's the property, this is what we're asking for, and whoever has the highest bid gets it done. So this is why we encourage clients more than ever before is when you're looking to purchase, don't wait till, tomorrow when you're ready, 24 hours. Even if you're not necessarily ready to purchase right now, start having that conversation with a mortgage agent or someone at the bank. So that way you have a better financial, what your financial picture is, and you have a better understanding of what the market is like as well. So that's typically the first step, is contacting an agent, laying out all the financial conditions, everything that needs to happen. And then once you're comfortable with the numbers, you've done your budget, then the next step would be Daryl, you as the real estate agent, to take over and make sure that the clients are within their budget.
So I know definitely when I'm first dealing with clients, my I have a series of questions that I go through, and one of my first questions is always to ask whether or not the client has is dealing with a lender yet, because you're absolutely right. There's the way the market's working now. We're moving so fast. I mean, the last thing buyers want to do is to fall in love with a house. And then start thinking about their financing, because they need to be ready to pull the trigger. So definitely my first bit of advice to clients, I always make sure that they're in discussion and they're actually pretty far through the process of applying for a mortgage with their mortgage broker. So what I'm thinking, and I think it's really helpful to know what sort of pieces of information are you going to look for? What sorts of questions are you going to ask before? What I appreciate as an agent is I really want to have my clients come to me and have them say, okay, I've talked to a mortgage agent or they've talked to the bank and they have a good idea what their budget is. So what would be the steps that you would take them through in order to find that number? Like, and I'm talking like, let's start right from the beginning. What kind of pieces of paper do you think people need? Will clients need to bring to you to so you can get a good picture?
Yeah. Okay. So obviously, great question again. It's obviously every client is going to be different. There isn't particularly like a set of, like step 1, 2, 3. Typically, if you're, it goes by, let's just start with the basics. Hopefully you're working, you're employed. If you're not employed, it's very difficult, even if you have a rich uncle that can help you out. They can typically help you with a down payment, but for the most part, when it comes to giving you a loan as big as a mortgage, we want to make sure that the at least the primary applicant is working. So that's typically the first step. And then we look at your credit score. Typically in Ontario, if your credit score is 600 Beacon and above, then you're typically good to go. Obviously, if it's higher than 680, you're going to have a better interest rate, a reduced interest rate, and there is a bit more flexibility with the lenders, especially if your ratios. So what we call like your total debt servicing ratio, we kind of look at it and say, okay, based on your income and your debt, can you carry on this new loan, which is the mortgage? So we look into that. Typically,
so let's slow down there. Sorry, sorry to interrupt, but let's just slow it down right there. When we talk about when real estate professionals talk about debt to
income ratio,
debt to income ratio. What really you're looking for? So
okay.
I know we want to talk percentages really, and not specific percentages, but sort of like ballparks, right?
Yeah.
So people want to be prepared, I think, to most people, they have a credit card debt or they have a car loan. I think it would be helpful to have an idea, okay, how is that going to really impact my likelihood that I'll qualify?
Okay. So typically, there's two sides of the ratio. So there is your GDS, which is called your gross domestic service. So that's basically any bill, so any expense related to the house. So that would typically be your property taxes, your principal and interest payment on the mortgage, and typically your heating cost as well. If you're a condo or a townhouse, we will typically add in what your condo fees would be or an approximate of what the condo fees would be. So once you have those two, because those are bills that is part of the house, comes with the house or the property. So we look into that, and typically the guideline is between 35 to 39% is typically what we're looking for of your income. And then,
so in other words, those cumulated expenses shouldn't be any more than 39%.
35% of your income. Exactly.
That makes sense.
35 to 39. And that's where your credit score comes into play. So the better your credit score, the higher we can go or we can push. Obviously, there is exceptions whereby we could approve a client who is 40% GDS, but they have an amazing credit score. They have repayment history their credit repayment history is good. Things like that shows that this is a responsible client. So the lender is willing to push the boundaries a bit. But if you're below 680, let's just say, for example, below 680 credit score, you've missed a couple of payments, whether it's your cable bill, your credit card, whatever it is, that would impact the lender deciding to go above the guidelines. Okay. And then on the flip side, we have what's called your total debt servicing ratio. So that's things that is not part of your property. So typically the average Canadian, you're looking at your car loan, student loan, whatever loan that you do have that you're financing, that's where that comes into play. So for the total debt servicing ratio, we're looking at anything maximum of 44%. So that's usually the max
Okay.
that we're looking at. So typically for GDS is 35 to 39%. And then your TDS is typically anything between 40 to 45%.
So are you saying that your total debts in terms of like, say your car loan and your student loan, your credit card bills, those, the threshold there is supposed to be that those together shouldn't add up to more than 45% of your income? Or is that, is it supposed to be those debts in addition to your mortgage payment, your home insurance, that sort of thing?
So they're two separate. They're separate. So typically, the numbers usually boil down to about 80% of your income. So they want to make sure. So when you look at what you're paying for your house on a monthly basis, so your principal and interest mortgage payment, your taxes, your heating cost, condo fees, whatever it may be that's attached to the property, plus whatever other debt that you have. Typically, it shouldn't be over 80 to 85% of your total income. So that's when you kind of add those numbers up. So if it's like an ideal client could be 35% GDS and 39% TDS. So that's around 80% of their total income, which gives so that's a whole 20% that you can actually save for a rainy day. You can save for expenses on the home. You can save for whatever you want to save for. But the main goal is the Bank of Canada wants to ensure, or CMHC wants to ensure, that you are not basically using 100% of your income to fund your expenses.
Excellent.
So
that's really, really important information and really helpful. Just to know, like I find a lot of clients, they don't quite understand, what they're getting into, how to really weigh their own expenses against their income to have a good sense of what they can afford. And a lot of times, and I've done shows about it. The question is, well, do I have the down payment? So there's more to it than just having that down payment, right? Having that cash in the bank. So this is that extra piece, really important to be able to keep in mind.
Yeah. So your down payment is obviously it's a very important part in the process. Obviously, the larger your down payment, which I'm sure we're going to get to eventually, the larger your down payment, it just means the more value of home you can get. So typically, I try to explain to clients that when you're going in for pre-approval, I'm never going to tell you what you can afford from a value of home. That's up to you to decide based on how much down payment you have. All I can tell you is the mortgage amount that you can qualify for. Right. So let's say you qualify for 300,000 or 400,000. 400,000 is the mortgage that you can afford. You can't go above that. You can go below that.
Right.
That's even better in the long run for you. But we're saying the maximum is 400,000. And then if you wanted to put 60,000 or 70,000 as a down payment, so that typically means you can most likely afford a $460,000 house or property. So that's how that works. So
when let's talk about the down payment a little bit. We generally we know that first-time home buyers, they are required to have a minimum down payment of 5%. A veteran, someone who's out there buying their second home, maybe they're moving, maybe they're doing an income property. Generally, they're required to have a minimum of 20% down on homes after their first. Is there really an advantage for a first-time home buyer to try to to get into their purchase with more than 5%?
Obviously there is pros and cons to it. Not too much of cons, I would say, but mostly pros. So typically, the general rule before the stress test came about back in, I believe it was 2017, spring of 2017, was if you didn't have 20%. So 20% just means that, so what typically happens is if you're putting anything less than 20%, your mortgage becomes insured. So there's insured mortgages and uninsured mortgages. So if you put in less than 20%, it means that CMHC, the Canadian market, sorry, CMH, the Canadian Housing Market Association will look at it and have to basically approve your deal. So you go to a lender, whether it's your bank, the bank tells you that this is what this is the mortgage we can approve you for, but because you put in less than 20%, CMHC has the final say, and if the property can be, if that client can be approved for that mortgage or not. So all it does is if you put 20% down, is you don't have to go through CMHC. You don't have to pay that default insurance, which could be up to, it could be anywhere from $10,000, an extra $15,000 to $20,000 that's added on to your mortgage plus interest. So so by having that 20% down, it's reducing your total mortgage amount. So that means that you're going to have less interest to pay in the long run. And it would also reduce your monthly expenses when it comes to like your principal and interest payment as well. So that's the advantages of getting that 20%. And plus, you also have more stake, more equity stake in your property too, which a lot of people who, you might move into your property in the next 6 months, your roof caves in because we had a crazy storm, especially if you live in Canada. A winter storm can blow your roof, can destroy your roof. So people who might not have enough equity in their property to refinance in the first 6 months, but by putting that, 20% down, you already have 20% equity in that property, which,
right.
In the long run, that could be a lot of money that could help you, service whatever you need to service. So that's the positive of the 20%. But in terms of the 5%, you'll have to go through CMHC. The higher down payment you put, the lesser the default insurance. So for example, if you put in 5%, so if you put in 5% of a down payment, you're looking to roughly pay about 4% of the property value of default insurance. So that's typically how it works. And then if you put in 10%, that reduces your default insurance to about 3% of the property value. So the more you put down, it helps. But my advice to clients, I always tell them is put what you can afford. If it's 5%, just put the 5% down. Save the extra money for repairs in the home or any other thing, because you don't want to be what you call house poor. You don't want to be house poor by dumping all your savings into the property. So that's typically the gist of it. And with the stress test, typically the 20%, when you put 20% down, you also didn't have to go through what's called the stress test as well. So the stress test is basically, sorry, I know it's a lot, but this is
It's
it's
always a lot.
Yeah, it's all policies from the government, right? So another thing with the 20% was if you put 20% down, you didn't have to go through what's called a stress test. So a stress test is basically the Bank of Canada saying we want to ensure that if rates were to go up, because we've been in a historically low rates for quite some time, low rates don't stay forever. At some point, we're going to get back to that 4 or 5% interest rate. I know, our parents, in the 70s, they can say that, they were paying about 20% on a mortgage. That's crazy to be paying 20% on a mortgage. So the Bank of Canada is just saying that in the event that rates did go that high, they wanted to ensure that people could still afford their homes. Right. So what they did was they said, if you're putting less than 20% down, then you have to go through the stress test. So let's say today's rates are 2%. The Bank of Canada stress test rate is at 4.75%. So they're qualifying you on the higher rate, and then whatever mortgage you can afford on the higher rate is what you get. And
Right.
then obviously once you find your property, everything is put in place, you will be paying the today's rates. But it just gives everyone, the lender, you as a client, it just gives everyone that peace of mind and buffer that you are that you're comfortable making your payments. But with the new incentives being proposed that should be starting this year, June 1st, even if you did put 20% down, you would still have to go through that stress test. So at this point in time, there's pros and cons, but it all depends on the person's financial situation and their goals.
So that's really important, really valuable information. I think it's important to make clear. So what the stress test is really doing is it's saying, okay, you can afford your mortgage, or it's asking the question, if you can afford the mortgage now, the stress test tries to build in some sort of insurance into the process that says, okay, 5 years from now, when you go to renew, if the interest rate were to increase significantly,
Exactly.
could you then afford, to keep your home? Because the last thing you want to do is to be forced into selling your home simply because the interest rates went up and you couldn't renew your mortgage at the current rates. That's correct?
Yes, that's exactly it. Because especially now, we saw interest rates go down to, I would say sometime last year we saw a 5-year fixed go for about 1.7%.
Yeah,
That's
we're
as
at
low
record
as
lows.
yeah, that's as low as it gets, and people were already at their max at
Right.
that 1.79%. So, like you said, in 5 years or 4 years, whenever it's time for you to renew your mortgage, and now the rates are 5%, the likelihood of those clients being able to afford it is extremely slim. If they've increased their income, then that's a whole different story. But we when it comes to financials and numbers, we work on today's numbers. We don't work on if or in case. We don't
Right.
work on hypothesis.
Well, let's definitely hope we're not up around 5% in a couple of, in like 2023. That'd be,
Especially with the cost of homes today, it would be.
uh, yeah, no kidding. Right at the moment, my retirement plan includes the pile of lumber I have in my backyard.
Whatever you can cash out, by all means.
I'm honestly waiting for the stores to be able to, to open again so I can return it.
Yeah.
Josh, you mentioned some incentives, and for first-time home buyers, that down payment, it's always the hurdle, right? It is the
Yeah.
hurdle, and I'm thinking of some pretty close friends of mine, and I know that they're sitting in their rental right now, and they just, they're working their butts off. They're trying to come up with that down payment, doing what they can, and they hear about these incentives. And there's always seem to be new incentives on the horizon. Can you tell us anything about the incentive programs that are available now? And maybe if you've heard something it sounded like you had like um, your crystal
Some
ball
thoughts.
was suggesting there might be something in the works.
Yeah. Well, so obviously, everybody knows about obviously a typical your first time home buyers plan that is presented, that the banks will present to you, or by the Bank of Canada. So all they
So
did
I'm not
was.
sure about that. If everyone knows,
Okay,
tell
I
us
will.
a
I
bit.
will go through it.
Yeah.
So the first time home buyers plan just basically gives first time home buyers perks in terms of sources for your down payment, as well as even when you're closing, legal fees, in terms of you don't have to pay for land transfer tax. So there is a lot of perks for first time home buyers. You also do get first time home buyers tax credits as well. So for those of you who recently bought your home and you looking to do your first taxes after buying your property, you definitely ask your tax specialist about the first time home buyers perks from a tax standpoint. It can really help you a lot in terms of just your taxes overall. So the basic first time home buyers plan is, so for example, when it comes to the down payment, is you can actually take a loan from your RSP. So we call it a loan just because your RSP retirement savings plan is for retirement. Anyone who takes out money from the RSP prior to retirement will typically get high taxes on their withdrawals. So what the government just said was for first-time home buyers who might not have enough down payment, they can take out up to $25,000 from their RSPs towards that loan without having to pay any tax penalties on that money withdrawn. The only thing is that you have to pay that money back. I believe it's between 12 to 15 years of taking that loan out. Okay. So, which is where I tell clients. So this is where I want to educate clients on is people always ask, oh, what about the RSP program? I want to withdraw from that. But that client could have enough money in their tax-free savings account or savings account. But people have the misconception that the RSP is made for that they can take money out from for a down payment. And I always tell clients, understand that it is a loan and it's for people who do not have the down payment elsewhere. So if you have a down payment that's sitting in your tax-free savings account, cash in your savings, use that versus your retirement funds, because now you have 15 years to pay that back or 10 years to pay that back. So depending on the amount that you took out, that's added expenses on a monthly basis. That's that loan that's now sitting on your head that you've got to pay back. So that's why I always warn clients, don't just use your RSP because you have it. Okay. Use your other sources of income, use your other sources of savings. And if you still need to top up, then your RSP should be your last resort. So that's kind of the gist.
And do those loans then factor into your debt to income ratios?
No, they don't. They don't factor in.
Okay.
So that's kind of like the perk of the first home buyers. They don't factor in because for the reality is if it's 10 years, it takes you to pay it back. The average Canadian usually spends about 3 to 4 years in their first home before upsizing or,
right.
Just, because everyone, you never find your forever. It's not never, but in most cases, you're not going to find your forever home on the first purchase. It's just when you're first starting out, it's not as easy as somebody who's buying their second or third property.
And that's honestly, that's the advice I always try to give first-time buyers. You have to think about it as, first of all, you're going to take a huge step getting into the real estate market. But it definitely makes the whole process a lot easier, a lot more manageable. If you consider your first purchase to be an investment one and, a step towards your next property. I actually even suggested to, and I guess I'll ask you this, and maybe it's something that you'll need to go back and research. Maybe it's something we can talk about another time. But one of the suggestions I've had for first-time home buyers is that they may even consider purchasing a home just for the sake of getting into the market, but actually using the home that they buy first as an investment vehicle rather than one that they might expect to live in. Because frankly, we're looking at average, an average detached home in the Niagara region, probably looking at $500,000. That's a big down payment. But my thinking and strategy that I've advised a couple clients on is, if you can get a $300,000 condo that you can rent for more than you're paying in mortgage, then the return there is possibly more than, it's likely more than your high interest savings account. If your first home, you intend it to be an investment rather than accommodations, does that, how would that factor into the application process?
Sorry, so repeat that last part.
So say I'm a first-time home buyer and I'm thinking I can't afford a home I can live in, but I can afford a condo that I can rent and keep as an income property. How would that impact my application process?
Okay, so this is for somebody, so they're renting right now and they're looking to get into the market, but okay, so that would typically be, so if you're not buying the property to live in it, then at that point it's considered an investment property.
Right.
So that's where you're now looking to pay about, you'll need to pay about 20 to 25% down payment. So typically
Okay.
25% for investment properties. So that's where it becomes tricky because, if you can't afford to live in it, then, the likelihood of you having 25% down is typically unlikely, except if you found somebody who can, loan you the money. But for the
Right.
most part, it's what I advise clients to do, like for what you were saying in terms of, just try to get into the market. The reality is you've got to do what's financially right for you. So if you're somebody who, you're single and you don't really have too many obligations, and you find that the housing market might be too expensive for you, then at that point, like you said, you can look for a cheap condo if you can find one. I know everybody wants to have that backyard. Everybody wants to have, I had a client that was just so adamant about, I want to have my space. I don't want to live in a condo. I don't want to do this. I don't want to do that. And I respect everyone's opinion.
Yep.
But sometimes when it comes to just what makes sense financially, a lot of times is, I don't want to use the word suck it up, but you got to start looking. And I think that's where you got to start running the numbers and look at, what is your long-term goal? Is your long-term goal to rent for the rest of your life? Are you looking to start a family someday? These are things that are going to play, that are going to make a huge impact on that decision. So that's what I tell clients is have that conversation. Don't just say, I want, is what do I need for my financial future? And that's usually where I would always tell clients to go in. Like we said, you can always go into that condo, build that equity, and now you now have a better purchasing power in your second home. And two, your income will most likely have increased as well. So there's a lot of factors that play, that create that positive change for you, as much as it might seem that you didn't get the property you wanted. So that's kind of how I look at it. It's like like your first car. Most people don't get, most people's first car is a beat up car, right? And then
Not a Ferrari.
but it's funny because we love our first car more than our second one. Everyone always talks about that Pontiac, Sunfire that they had that, never gave them issues. So it's similar to a house, but as long as you've done your research, then, and also the myth of renting is not a bad thing. And I think the myth of, oh, if you rent, you're throwing your money in the garbage. I don't necessarily believe in that. I don't think everybody should own a property, and I don't think everyone, so that's why I believe that sometimes your rent, let's say you're somebody who been living in a place for the last 5 years, you were lucky to get, very low rent at $500. You don't really have a family. You're just looking to build equity. You're looking to continue to invest. Right now might not be the greatest time to get into the market just because of how expensive it is. So in that, when you kind of look at it in the grand scheme, maybe paying that $500 a month rent works for you for now, right? And you can put that money into other investment vehicles that could still produce the same rate of return as a property. So it's really about just having the right conversations, like I always say. I love having these conversations with my clients because I was also a financial advisor as well. So I always look at the full picture of, it's not just about, I want to buy a home and this is what you can afford.
It's important to
If that
have
makes sense.
the big picture in mind, right?
Yeah.
So the big picture these days has been it's been tough, So we've definitely, I think, touched on some of the important issues with respect to the current market, first time home buyers. It's absolutely important that very few real estate agents will honestly bring clients to see homes until they know they have a fairly solid pre-qualification.
Yeah. And sorry, I didn't finish on the first time home buyers incentive. Sorry about that.
Sure, yeah, let's hear it.
I was just explaining the original first time home buyers. But just a quick thing on that. So the first time home buyers incentive is just the government trying to help first time home buyers even more, especially with the introduction of the stress test, whereby a lot of first time home buyers were seeing that they couldn't qualify for, the average cost of homes in the market. So the government came about this program, I believe it was September of 2019, whereby they will be able to match up to between 5 to 10% of whatever you've saved. So minimum requirement is that you should have 5% of your property that you're looking to purchase saved, and then they will match 5% as well. So that gives you a total of 10% down payment, which in most cases will allow you to qualify for that property that, CMHC might ask you to put more down. So that's basically the loan that the government gives you. And what that is, and the government is giving you that 5%, but they're also asking for a 10% stake in your property. So all that means is they're going to own 10% of your property. So people have debated if it's a great plan or not. But for somebody who is desperate, who has a family, they just don't want to keep renting anymore. They want to have that space. It is a great program for that.
So the 10% stake, as far as I understood it, it was the government would actually be contributing to the purchase, 10% of the purchase value of the home.
Yeah.
Right? And then you could actually buy them out of that stake.
Yeah, so you'll be buying them. So they'll own 10% of the value of your property. So basically, they own 10% of your property.
But they are contributing 10% of the purchase cost, are they not?
Yeah, so they help you with the 5%. So typically, they can go up to 10%, depending on if it's a new build, things like that, or multi-unit building. Then they can go up to 10%. But on average, it's 5%, and then they typically will own about. From my understanding, it's 10% equity is what they would own.
So the percent, their equity isn't equal to the contribution?
No, is whatever. So they'll own 10% of the value of your property. So if you sold it 25 years from now, whatever 10% of what you sold it is what you would have to pay back the government. Or if you're looking to pay the government back, let's say 5 years from now, you decide, you know what, I just want to pay them out. They're going to appraise your property and figure out what is the current market value of your property, and then they would take the 10% out of that.
Interesting.
Yeah, so that's where
we should definitely do a show on these incentives. Just focus on these
we can definitely have a show on it. That's where some people say it's not a great program because people can imagine giving up 10% of an asset, right? But in the long run, it gets you in the market. Yes. Your house is going to appreciate, especially in Ontario, where actually all of Canada, we're seeing like massive growth in the real estate market. So for some people, it is worth it to get in, sell the property, pay your 10%. You still have a lot of equity left that you can go and buy that dream home, right? Because let's face it, we could try to keep saving that 5%, but just in recent years, we've seen that the appreciation of homes is a lot faster than you can ever save. Saving that 5%.
I can tell you, my own home it could probably sell for 3 times. I know it'll sell for more than 3 times what I paid for it. I could put it on the market right now for 3 times what I paid for it. I know I'm dealing with clients right now who are listing their home. They haven't owned the home very long. They purchased their home in 2014. They can list. They're listing their home right now. They're probably, this property is probably worth 4 times what they paid for it. So
exactly,
there's definitely, when you're making a 400% return, it doesn't. I would think
that
it shouldn't hurt so much.
So big. Yeah,
to be making a 360% return as opposed to the 400% return. Exactly,
because at the end of the day, I don't know what income stream you have, but you're not making 400% return on any investment. I don't care what that investment is. So, so that's really the main incentive that they have. Obviously, there's other triggers. We can probably do a show on that. There's other triggers that would force somebody to have to repay that before the 25 years is over. Obviously, it could be a separation could cause and that would trigger, or if you did a refinance. So that's why clients have to ask, um, have to know the right questions to ask their bank or their mortgage agent, and before taking any mortgage, before signing any contract, is understanding what are the stipulations to this contract. Can I refinance if I wanted to? Can I port my mortgage? Can I there's so many things that you might not be able to do depending on the mortgage that you get. So that's why it's very important to ask those questions to your representative
We
as
should,
well.
yeah, definitely. Um, yeah, before the week's out, I think we should plan a show where we talk about these incentives specifically. Um,
Yeah.
are there any other things that I started heading down this path. Are there other things that you think that the current market has changed in terms of the process for applying for a mortgage? Like, um, to me, what I'm seeing is that the clients have to do, the application part, a good portion of the application part, kind of upfront, so
Yeah.
that they're prepared to go into their bid with ideally a minimal finance clause. I mean,
Yeah.
ideally these days with no finance clause, but that's just not realistic for especially first-time home buyers.
Yeah.
But we're doing, a lot of the process upfront, so we can say, look, we can have an answer for you in 3 days. But other than that, are there actual different restrictions that people are looking at? Are there different pieces of information that are required, or is it more or less just we're changing the sequence?
There is it's things are is pretty much similar to how it's always been. Obviously, lenders are now checking because of, unfortunately, C-19.
You
Lenders are
mentioned
looking
C-19. What is C-19?
COVID-19. The
Oh,
reason I
okay,
say
okay,
C-19 is because
of
certain
course.
platforms don't allow you to say the word, so it's become that streaming code of C-19, just so that way we don't get flagged for whatever reason.
Oh,
That's what.
it's
That's why I said C-19. But
my bad.
yeah, no worries. No, at the end of the day, it is what it is. We can't hide from what's going on.
No.
But yeah, so just because of COVID, a lot of lenders are now strict to make sure that whoever the client is applying is not receiving any government assistance. You're not inflating your income.
Yeah.
They also look at the industries that you're in. So I remember when I was working at the bank, one of the things that we looked at was, because now it's the lenders have kind of tiered all the industries from high risk to low risk. So if you're
Okay.
a car sales guy, you're on the high risk. If you work at a restaurant, a chef, you're considered high risk. So they look at that and say, okay, so at that point, you definitely need a letter of employment to prove that you have been working or you're guaranteed work. So those are the things that have kind of changed. Is they look at the industry now as part of the, not just, I won't say the character, but it's one of the 5 C's of credit, which is typically your character, your capital, collateral, credit. They've now added that, what industry are you working in? Obviously, if you're in healthcare, that's a slam dunk, because health professionals are needed more than ever before. So you're not losing your job anytime soon. So those are the kind of
Oh,
things
you
they look
think
at
they might be
now.
burnt out?
Exactly. If anything, might
Yeah.
be burnt out. So those are the nuances, the differences in terms of the process. Other than that, I think everything is still kind of very similar. I know it's really about doing your research, having a trusted agent. It doesn't matter. It doesn't mean the agent has to be in business for 20 years, but it's just looking at an agent that knows what they're doing and has that experience. So when we talk about condition of financing, we can never tell a client that they can go in without a condition of financing. But most agents who are experienced can run the numbers and know, okay, with everything being said, that's why I tell my clients for pre-approvals, I want to have all the documents
Yeah.
today. I don't
No
want to wait.
surprises.
I don't want surprises. I don't want to wait till 3 weeks down the road, or 48 hours to closing before you start giving me your documents. I want we have the first meeting, we have that conversation, and then you need to provide me all the documents that I need. And then once I put in all the numbers and run it, I'm certain that 9 out of 10 times you will be approved. Am I ever going to tell a client straight to their faces that don't put a condition of financing? But I create a system whereby the client goes in confidently knowing that they are good. They're good. So that's why we look at those guidelines, look at the scenarios, look at their credit. And once, you've crossed all your T's and dotted your I's, then you can go in and the market is so competitive now that you want to make sure that you're doing your homework, but don't sleep on it. As long as you've come to the agent, a mortgage agent or the bank, and you've done your research, you know what you want, you've had a good conversation. When you see a property that you like, act on it. Don't wait. Don't sleep on it. Don't. And another thing I found too recently from clients is a lot of clients are hesitant. I think you might be able to speak a bit more in this, Daryl. Clients are hesitant to, put their best foot forward. People are still kind of, I don't want to pay this much. I don't want to pay that much. And I'm finding that a lot of times clients are being boxed out of the market, but it's only by maybe $5,000 difference. So I don't know if you may be able to speak on that a bit.
Well,
it's a tricky one. It's tricky, but
it
I always tell
definitely
clients,
is. And
put your best foot forward. And, and at the end of the day, you have a real estate agent that can guide you on what's a reasonable price based on comparables in the market. Go with your agent's, advice. That's all I can say.
It's the best advice right at the moment. And I've said this in some of my previous shows, and I've repeated it. My clients, if they're watching, they know they've heard me say this before, that in this market, you do have to go into every bid with the understanding that you're not going to get a second chance. So, on the other hand, you don't want to overpay for the property. But what really, I think, in this market, overpaying for the property is putting in your bid, being really aggressive, and waking up in the morning with absolute buyer's remorse. Right? What you have to do, and I've gone through this process a few times with my clients, so you have to decide for yourself with of course the advice and guidance of your real estate professionals, your realtor, with the knowing what how your mortgage agent has guided you. You have to come up with a number that you are comfortable paying. And it has to be your best possible number. It has to be the sort of number where if you get beat by $2,000, you're fine with that. I've had some clients in some recent bids. They lost out on one particular bid by $7,000, which in the grand scheme of things is really not a lot of money. When you're looking at spending $800,000, like close to $1 million on a house, that $7,000 amounts to something like a cup of coffee every week in terms of your mortgage payments. But they were fine with that because they knew they had a number. It was their upper limit, and they had told themselves before they went into the bid, that's the number that they will not breach.
Yeah.
Right now, sometimes it takes a couple bumps and a couple heartbreaks before you really appreciate what, this is kind of what I've seen with some clients. It takes some heartbreak for them to really appreciate the advice that I'm giving them.
Yeah.
And so they miss out on properties that they might have otherwise purchased because they had that sort of timidness, going in.
Yeah.
You don't get a second chance. You really don't. Not in today's market. I think it's something that people don't quite appreciate or don't quite understand. The general public doesn't quite understand, and you and I both have to deal with this, right? It's that our industry, and we work different parts of it, but the industry that we work in, at the foundation is this relationship we have. We have a client an agent relationship, right? We're the agents, they're the clients. But what people tend not to appreciate is it's the client, it's the transactions, the activities that we're in, that we help facilitate, they're client driven. And it's important that when we're taking steps, we're doing so under the direction of the clients, right? Because we're acting on behalf of our clients, and maybe it's more so with a real estate agent, but you can see this. It comes across in all the agreements that we have as real estate agents with our clients. Like when we have a listing, the document that the client signs is an authorization to sell the property. Right. Yeah. So they're authorizing us to sell the property on their behalf. It's the on their behalf part that sometimes they miss. And so as much as we want to say, okay, I think this is the way this bid or this competition for the property is going to go, we can say that, but when it comes to our actions in order to secure the property for our clients, it has to be the client's decisions that direct our actions, right? Yeah. So the clients have to make the decisions. The clients have to be comfortable with the decisions. But
that's where I think
it's a hard lesson, right?
But that's where going with a trusted agent, it makes the client's job a lot easier, right? Yes. I think it goes back to, as much as it's the client's decision. Obviously, they're the ones buying the property. It's their money. Yes. If the client has done their budget, done a great budget to know what they can and can't afford. The mortgage agent has run through the numbers and said, this is, after buying this house, you can still afford that vacation or whatever it is that whatever your life goals are, right? You can still afford those things. The real estate agent is going to show you comparables, what has sold recently. Even I, as a mortgage agent, I have access to, you can give me a property and I can pull it up and I can pull up the appraisal report to figure out, the last home that sold around that neighborhood, or a house that's comparable. So it gives you, there's so much data out there that it educates your decision, that it allows you to make an educated decision, so when you're going in. So that's why at the end of the day, we can never be perfect. At the end of the day, everybody has overpaid for a house, for a car, for, we all overpay for something at the end of the day. It's just a matter of, as long as you've done your due diligence and you've educated yourself with the right professionals around, you can't really go that wrong. Like, it's hard to go wrong in that aspect. Yeah. And I think the one thing that you have to do, and I'm sure you tell your clients that, never go in without condition for an inspection. You need to do an inspection. I don't care how amazing the house looks, especially when you live in Niagara. The city, Niagara is a very old region. We still have houses from, 1860. So the likelihood that there's something that there could be issues with the foundation, with something that, could not be seen with the naked eye. Often sometimes appraisers, they miss it, right? So it's making sure that you're going in with an inspection. That's something I feel like that is non-negotiable.
Well, I gotta tell you, it's a big negotiating chip right now in today's market. You're not seeing a lot of inspection clauses, and you're right. And that, it goes back to, including that clause. It has to be the client's decision. Yeah. When a client does choose not to include an inspection, I generally advise that they get one anyway, whether it's the condition of their sale or not. And again, it's like all about surprises, right? So I'd rather know that there is a big expense looming that I will have to address once I move, than to, move, get all comfortable, be living on a shoestring in terms of my budget, and then all of a sudden be surprised by a crack in the foundation or something
Yeah.
like that. Inspections, they're a completely different issue. It's a good segue though, because next week I'm going to have Aaron Beaver, a home inspector, on the show. It's going to be, I think, a really interesting discussion to get his perspective on where the inspections fit in. I mean, I don't think anyone would say, I think everyone would agree with you, right, that
Yeah.
inspections are so important. It's just they're being negotiated away in the current market. Maybe we'll see them come back now that we see just a slight bit of cooling. But anyhow, Josh, I'd like to thank you for your time and all the great information you've brought us today.
I appreciate it.
We're definitely going to connect again. I definitely want to talk about incentives and thanks again for your time.
Thank you. I appreciate it. And hopefully this was a bit of value for the viewers. And yeah, I hope to be on here again.
Absolutely, for sure. I'll talk to you again, Josh. Thanks.
Take care.
So, wrong one. Thank you very much for joining us today. Like I said, next week we're going to have Aaron Beaver, home inspector, joining us, and he's going to talk about, we're going to talk all about home inspections. He's probably going to talk a bit about, red flags, things that you can look for in today's market, yourself. And really, I think we're going to talk about the value of having a home inspection, whether or not it's the condition of the sale or the purchase of a property. I do think I know that I've made purchases myself. I've had clients make purchases where the home inspection has brought to light important details, and the value of it really was now knowing that there was a problem in the home that needed to be fixed. I could budget for it and have it taken care of before it became a major crisis. Anyhow, I hope you enjoyed today's show. Josh gave us some great information. I know we're going to have Josh back in the future. If you're liking the information we're sharing, please don't hesitate to hit the like, to hit that subscribe button. We're glad to have you aboard. I'll see you next week at 7 p.m. Thanks again for joining us.